Hello again, and welcome to our monthly recap for May 2023. A lot to get into. It was a very busy month on top of a very busy year. Let's dive in. So, starting with this crazy year, and it has been a truly crazy year. So, I was going to change this entire slide from my previous monthly recap. I'm like, wait, all these themes are still the same. We added through on the debt ceiling crisis. But outside of that, second verse, same as the first. So this year we've seen three Fed rate hikes, February 1st, March 22nd, and then most recently May 3rd, very beginning of May. Each one was for 1/4%. That's the 10th consecutive rate hike we've seen. And the Fed rate now sits at its highest level since August 2007. That was right before the Great Recession of 2008. And with that, the Fed slashed rates to try to spur spending. But the Fed rate currently sits at a rate of 5 to 5.25%. That's the highest level again since August 2007. And that Fed funds rate, that is the rate that banks, credit unions exchange money with each other at. So if one bank wanted to lend more money on the commercial side, they might go and borrow money to do so. And when they do so, they are borrowing that money at that rate. So that is the rate that banks, credit unions are exchanging money with each other at. Because of that, it affects all of those portfolio loans. So credit cards, car loans, any type of vehicle loan, RVs, boats, anything like that. Personal loans, home equity lines of credit, savings deposits, all of those are portfolio money. It is the bank or credit union's own personal money, and it is directly tied to the Fed funds rate. So it does not directly impact first mortgages. It does impact portfolio loans. Another kind of common theme this year is banks faltering, and specifically it's mid-sized community banks that are faltering. And another one joined the list in May. Debt ceiling, that is the one new piece. It's happening every 2 years like clockwork now. You'll find out that if the can gets kicked, and it sounds like it's probably going to, it's going to get kicked 2 years from now. So we have this conversation again then. And then I'm also going to be talking about some housing news. All positive data, Denver especially. So let's get into it. So May, I mentioned another bank failed. That was First Republic. JP Morgan Chase swooped in, acquired their assets, acquired their deposits. And all these community banks, there's really two common things. One is they're community banks, mid-sized regional banks, but they're banks and not credit unions. And the reason why is because credit unions, by their very nature, they have to grow organically. We cannot simply go to Wall Street and raise capital and lend it out. We have to grow organically. We grow by our membership, the people that we serve in our community. For Elevation's credit unions, anybody who works or lives in Colorado, right? So because of that, they grow organically. They're used to high interest rate environments. They're used to low interest rate environments. They've learned to weather the storm, like my little storm picture. They've learned to weather the storm in all sorts of different interest rate environments. Well, banks, they can simply go to Wall Street and raise capital. Because of that, they may not be built as foundationally well as some of those other institutions. They may pop up overnight. Because of that, they may not have time to adapt to different environments. And because of that, they may be a more risk of interest rate fluctuations. And the second thing you're going to notice is that all of these financial institutions that have failed because they've made some bad bets. So what happens is when banks, credit unions receive money, they keep part of that money on hand. They then turn around and invest the rest of it elsewhere. And they do so because they can earn more money, and that by gaining those profits, they can then turn around and lend more money, thus increasing their profit margins even further, right? Well, one thing that institutions have done is we've been in such a low rate environment for so long, a lot of them bought up a lot of treasuries at very low paying yields, very low paying rates, very safe investments, but very low rates. Well, when people start to withdraw money from that institution, and this can be spooked because of social media or news, whatever, Kramer talking on Squawk Box, well, if enough people get together and start withdrawing cash, they may access more than the liquid funds that institution had on hand. And that means the institution now has to turn around and start to sell assets to cover the withdrawal of funds. Well, when the institutions were borrowing money from the Treasury, they were doing so at very low rates, let's say 2%. Well, as those rates have increased, let's say 5%, now all of a sudden that 2% yield is no longer worth 2%. Why would 2% not be worth 2%? Well, it's because an investor can literally cross the street and buy that same asset at a much higher paying yield. Why would they not want to do so? So that 2% was no longer worth 2%. So now when institutions have to sell those assets, they have to do so at a loss because that asset is no longer worth what it was once worth. So now they're have a run on their bank, they have a run on their funds, they have to start selling assets at a loss, and that compounds the issue and leads to a bank run and leads to banks failing. So that's what we're kind of seeing going on. So the Fed has been saying, we don't really care. We don't really care the banks are failing. We are going to continue our path forward and hike rates yet again. It's a very gutsy move that the Fed is doing of hiking rates in the face of banks failing because of rates literally being hiked. It's a very gutsy move. They don't seem to be nearly as concerned with banks failing as they do inflation as a whole. So the Fed hiked rates again, as expected. Now the Fed did come out and say, look, we're not expecting any more rate hikes. Unfortunately, a bunch of Fed members went rogue. I'll be talking about that on the next slide. Another thing that happened in May, very strong jobs reports. We've been getting very strong jobs reports literally all year this year. ADP was expecting 150,000 job gains in April. That came in at 296,000 job gains. BLS, Bureau of Labor Statistics, was expecting 180,000 job gains. That came in at 253,000 job gains. So strong reports, constantly exceeding expectations and just kind of knocking it out of the park. And May also kicked off what I expect is going to be a string of very good inflation data. So CPI, Consumer Price Index, inflation as you and I, us consumers feel it, is currently at 4.9%. That one at one point was as high as 9.1%. PPI, Producer Price Index, which is inflation as businesses feel it, so on the wholesale level, that's currently at 2.3%. That was once at a high as 11.7%. So seeing significant improvement on inflation. Going to continue to expect that to improve. We're going to be replacing a lot of very warm reports with some cooler reports that should continue to drag inflation down. As it does, mortgage rates are also going to improve. Mortgage rates and inflation tend to track with one another. And then mortgage rates. Those are one kind of the big downside this month. Mortgage rates took it on the chin. The reason why was because of the debt ceiling. That spooked a lot of the markets, including the mortgage-backed securities market. Rates started off the month around 6.625%. Today, they're hovering right around 7%, 95% loan to value, 780 plus FICO score, single-family residence, primary residence, that scenario. But just a couple of days ago, it was as high as 7.125. So rates have been improving the last couple of days, but as a whole, May was not very kind to mortgage rates. They did not like what was going on with the debt ceiling. So where does the Fed stand currently? The Fed removed language on their meeting. So they first meet and then they have a press conference. And in that press conference, they removed language from their press conference, which said, or their statement, which said, some additional policy firming may be appropriate. Policy firming, that is the Fed speakiest of Fed speak. And what policy firming means is rate hikes. Okay, so what they said is, look, we think we're done with rate hikes. Yay, that's really good news. However, Jerome Powell did something kind of clever. He carved out a gigantic escape clause, which is our future policy actions will depend on how events unfold. So we're done with Fed rate hikes unless inflation starts to creep up again. We're done with Fed rate hikes unless the jobs market continues to perform very, very well, in which case maybe we have to hike some more. So they gave themselves a gigantic escape clause to kind of skirt around this if they decide to reverse course. We always told you we're going to be data dependent. Didn't we tell you we're going to be data dependent? Yeah. Now, once they did that, everything was kind of like looking great. Hey, great, their Fed's done with Fed rate hikes. Inflation seems like it's going to be stopped. We're all good. Business as usual, keep moving forward. And then Fed members went completely rogue. Bowman, Bullard, Bostic, Barron, and I really wish it began with a B, Logan. They all came out and said, hey, look, we might need further rate hikes. We might not be done. We might have further rate hikes to do. When they did that, the markets shift, and all of a sudden, the probability of a hike on their June 14th meeting increased to about 40%. Jerome Powell came out, tamped things down, said, hey, look, calm down. As I said, we think we're done with rate hikes. Stop freaking out. We don't want to cause any more bad blood with the banks as much as we already have. So calm down. When he came out and kind of put out the flames a little bit, the probability dropped to about 20% for a rate hike in next month's meeting, or this month's meeting. I guess technically next month. Recording this on May 31st. So another, like I said, debt ceiling was front and center this month. President Biden and House Speaker Kevin McCarthy reached a deal in principle. Whew, so step in the right direction. Now, immediately after that, Kevin McCarthy probably started freaking out a little bit. And the reason why was, if you recall, it took him 15 votes to get voted as the House Speaker. And the reason it took so many votes was because there was a lot of division within his own party trying to get the votes to make that happen. Well, one of the concessions he made was he put some very hardline individuals on his committee that would actually approve whether or not a bill gets passed to the actual floor. So he made a lot of concessions, and one of those concessions was he got a couple really hardline people on that committee that would actually approve what things did not make it to the House floor itself. Well, now that's coming back and kind of biting him in the tuchus a little bit. They did get that vote passed by the narrowest of margins. That happened last night, Tuesday, May 30th. So he got enough support to get this thing in front of the House for a vote. That vote is supposed to happen literally today, Wednesday, May 31st. The hope is that the moderates come together, they pass this along, it gets to the Senate. So hopefully the Senate can review it Thursday, maybe Friday, but hopefully Thursday. And then hopefully by the weekend, the president has something to sign off on. Now, originally it was slated that, hey, June 1st was going to be the date that we ran out of money to pay our bills. That got pushed out to June 5th. If you give a mouse a cookie, it's going to want a glass of milk. They're going to take up every single day that they have to deal with this. I wouldn't expect anything to happen other than the 11th hour at this point. That's just how it always goes. That's how it went in 2011. And what they did was they basically kicked the can. They're basically punting till January of 2025. Another election cycle will be in the rearview mirror. It's going to be somebody else's problem. Now, side effect of this is that the Treasury is going to have to issue another over $700 billion in new treasuries to pay for what they want to pay for. Well, treasuries, government bonds, and mortgage-backed securities, which is housing-backed bonds. Mortgage-backed securities are what mortgage rates are based on. They're both considered very safe investments. It's a bond market, a promise to pay, fixed term, fixed rates, very low-risk, secure assets. Well, they compete with each other for money. So the concern is that issuing all these new treasuries could start to cause mortgage rates to tick up in the future. That is a problem for future Aaron. That is a problem for future consumer. For right now, we'll take what we can get. And as I mentioned, rates are just as a whole reacting very positively to, hey, look, this may be in the rearview mirror soon. Thank all that is holy. Next is housing data. So housing data is starting to turn around. This is a little bit dated. So the housing data we just got is for March of 2023. So it's a couple months old, but still very relevant and useful information. There's really two major housing reports. There's Case-Shiller, and then there's FHFA, which is Federal Housing Finance Agency. So Case-Shiller is the entire housing market. They measure really expensive homes, very cheap homes, cash deals, non-cash deals, finance deals. They measure the whole thing, which is why they're considered the gold standard for appreciation data. FHFA only measures appreciation for homes with a conforming loan. So conforming loan is 726,200 or less. There's what they call super conforming, which is high cost homes in those areas as well. So a little bit of flexibility there, but generally 726,200 or less. So FHFA is slated towards the lower price points portion of the housing market. And because of that, we see some very, very strong numbers. There's more buyers at those lower price points. It attracts investors, it attracts divorcees, first-time home buyers. It just attracts a larger pool of people than the $1 million homes, which are going to attract a smaller portion of the whole public as a whole. So the lower price point year over year, so March 22 through March 23, it's up 3.6%. And from the peak, so like July of 2022, right when we saw things start downshift, from the peak, it's up 0.7%. So we're actually up from the peak. Very good news. If you have an kind of entry-level home, 726, it's shocking that that's an entry-level home on the front range, but that's where we are. Case-Shiller, on the other hand, again, the whole market as a whole. Well, year over year, so March 22 through March 23, it's only up 0.6% from the peak. July, it's down 2.3%. That's not shocking considering, again, those higher price point homes are likely to have more inclination or more likelihood of a price cut than a entry-level home, which has all that competition built up. So market as a whole is starting to rebound. It's starting to improve. And from the peak down 2.3%, you might hear that and not be very happy with it. But who buys a home in, July of 22 and sells it in March of 23? It's just not very likely. And we've only seen the market improve since then as well. Again, these are kind of dated reports. Also worth noting that Denver Metro is amongst the best performing areas in the entire country for the last couple months. Only San Francisco, San Diego, and Detroit were performing better. So Denver is performing very well. The housing market as a whole has definitely changed course. Things are definitely starting to pick up from an appreciation standpoint. And I think this is only going to continue. I think April and May reports, when those come out, the next couple months are only going to be better. So things are certainly moving in the right direction. So looking ahead, updated inflation figures, we're going to be getting those on June 13th and June 14th. Again, shelter component is going to start to play catch up. We're also going to be replacing some very warm figures with some cooler figures. All that should lead to inflation decreasing. As inflation cools, mortgage rates improve as well. They track together. Next Fed meeting is on June 14th. They said 20% likelihood of a Fed rate hike. I disagree with that. I think there's no chance of a Fed rate hike. The banks have been beat up enough. Inflation's coming down. And since they're going to get that updated inflation data on June 13th and June 14th, when that Fed does meet, they're going to be having the most recent up-to-date information. And I think they're going to be seeing some strong improvements, which gives them enough reason to not hike rates. The markets are actually starting to predict rate cuts later this year, not rate hikes, rate cuts later this year. That would be in lockstep with if we did see a recession. If we did see a recession, Fed tends to cut rates. They want to spur spending, as you all know. Markets should be getting back to basics now. Now that the debt ceiling crisis is in the rearview mirror, please, the market should be returning to normal. So that'll be nice to see. The rates certainly got beat up this month because of it. And then jobs reports. They've been scorching hot, but we got new jobs data coming in June 1st and June 2nd, so literally tomorrow and Friday. Reports have been scorching this year. I think we're probably due for a little bit of a pullback. I'm not quite sure what we'll see, but yeah, we should be due for a little bit of a cooler number on the jobs fronts because we've had so many strong reports for such a long period of time. So that's what I'm looking forward to the month ahead. That is it. I hope this was helpful. Thank you all for the continued feedback. It doesn't change it changes always how I go about my presentation. So thank you. I want to know what's helpful to you, what's useful. Please let me know. I use that information constantly. It does change how we go about things. And as always, thank you so much for the referrals. It is the lifeblood of our business. We do not take them for granted. We are always grateful for you and your support. So thank you so much. And yeah, if you think of anything else, let us know. Appreciate you. Have a good one.